Welcome back at 7:45. The U.S. got hit with an economic double whammy this week. While the cost of living in the U.S. keeps climbing, finding a job is getting more difficult. The latest consumer price index showed the biggest year-over-year jump, since January. Meanwhile, first-time applications for unemployment benefits last week hit a high not seen since October 2021. Burns financial advisor Tim Dahlberg joins us to break down what all of this means for us, the consumers. Tim, good morning. Thanks for joining us.
Thanks
so
for having
I
us.
kind of hit people with a lot of information in that one little introduction there. So let's pull out each of those segments if we can. Let's start off with the cost of living numbers. What did we learn this week about that?
So cost of living, CPI number came out higher than expected. So some of the key drivers that are in there, you have housing and food. So let's think about shelter. That's going to include any rentals, any travel, food prices. That's another big one. Airline travel, any new and used cars. Those things are all going up as well. But one of the things that is good, if we strip out any of these volatile items, such as your food, such as your energy, the CPI numbers actually came in line with expectations, which is a good thing. So that actually increases the chance that the Fed's going to cut rates next week.
Let's talk about the employment numbers, unemployment numbers. What can those tell us about the state of the economy and, again, what the Fed could potentially do?
Yeah, that's right. Whenever you have hotter inflation with a cooling labor market, the economists are always going to be talking about stagflation, right? We're going to have a little bit slowing growth with also rising prices, always a concern. It's not a prediction yet, but if this trend continues, it can be an issue, but that's even more the reason why the Fed needs to start cutting rates now.
So let's talk about what the people can do, because we just talked about what these numbers say. We talked about what the Fed will or will not do, but people at home are like, okay, I'm in the middle. Where do I go? Where do I look?
So if you're in the middle at this point right now, what you want to do, start looking at your cash flow. What's the income? What's the spending, your expenses? If we think about the housing and the food costs, if you're on fixed income, that can impact you as well. So now, if we know that the rates are coming down, this is where we need to start looking at the portfolios, maybe doing some rebalances, because as these rates come down, CD rates go down, the money market, the high interest savings. So if we're going to maintain that income, let's start looking for some alternatives, maybe laddering some bonds, maybe some annuities, even some structured notes. Now, stay flexible, because if inflation does continue to rise in this, then we need some investments to keep up with that inflation. So then you might start looking for stocks, maybe some dividends paying stocks, or even some inflation protected securities.
Anything you want people to not do right now?
Yes.
Again, these numbers are kind of all over the place.
That's right.
We have no control over what the Fed does or does not do. So what's one thing you want people to just don't do, never do?
Look, don't panic over any single report, okay? That's one of the big things. Stay diversified, stick to that long-term plan. Look, there's multiple rate cuts that are expected for this year, before the end of the year. That is actually going to help the economy. It's going to help the market. So don't panic, just stay the course.
That's the key here. Don't panic and look at what you have in front of you and keep to that long-term plan.
That's right.
If you didn't hear anything else you said, those three things. Well, Tim, thank you so much for your time this morning. We appreciate you.
Thank you, Simone.
All right, let's get over to Nikandra Norwood.